One of the most important decisions a business faces is deciding where it should position itself within its value chain. Essentially, a company must choose whether to own and manage the key activities involved in making and delivering its products or to rely on external partners to handle those tasks. This is known as the choice between vertical integration and outsourcing, and it significantly impacts costs, risks, flexibility, competitive advantage, and profitability over time. While this decision is often described as a trade-off between control and flexibility, the reality is more complex. Vertical integration can help build strong competitive barriers and improve customer experience but requires significant investment, expertise, and management effort. On the other hand, outsourcing can provide faster growth, greater scalability, and allow a company to focus on its core strengths, though it also introduces some risks due to reliance on others. There is no one-size-fits-all answer. The right choice depends on aligning the strategy with the company's goals, industry dynamics, and competitive context. To understand this better, it's important to know that vertical integration means a firm owns or controls different stages of its value chain, either upstream by acquiring or developing suppliers and production capabilities, or downstream by owning distribution, retail outlets, or customer interfaces. This presentation will explore these concepts in depth and help clarify how leaders can make informed, strategic choices between integration and outsourcing. Outsourcing means hiring external companies to handle tasks that could be done internally, like manufacturing, logistics, IT, customer support, or research and development. This approach helps companies focus on their core strengths while relying on specialists elsewhere. The choice between outsourcing and vertical integration impacts many areas such as cost structure, innovation speed, risk management, brand control, scalability, and strategic positioning. In industries with thin margins and little differentiation, outsourcing is common, while in sectors where brand quality and reliability are critical, owning more of the value chain often gives a competitive edge. This decision isn't fixed. Companies may move between outsourcing and integration over time depending on their needs. When deciding, it's important to start by identifying activities that shape competitive advantage rather than just focusing on cost. Tasks that directly affect product uniqueness, customer experience, or proprietary knowledge are usually better kept in-house, while standard processes benefit from outside expertise. As a simple guideline, if something is a key reason customers choose your business and pay a premium, it's worth controlling. Another important factor is assessing how specific the assets are and the dependency risk involved, since outsourcing works best when these risks are manageable. When inputs are widely available, with many suppliers offering similar products and low costs for switching between them, outsourcing tends to make more sense. But when inputs are rare or highly specialized, suppliers have strong bargaining power, or disruptions could seriously impact core operations, vertical integration starts to look more appealing. If your business depends heavily on just a few external partners for critical functions, owning those parts of the supply chain can reduce risk. On the topic of scale, outsourcing often wins when suppliers operate at a large scale, spreading fixed costs across many customers and gaining learning advantages faster than any one firm could internally. However, vertical integration can be powerful if your company can achieve scale on its own, demand is steady, and tighter control leads to better learning over time. Then, there's the question of capital and management complexity. Vertical integration requires significant long-term investments, strong operational capabilities, and expertise across various activities. Outsourcing shifts many fixed costs to variable ones and replaces operational complexity with contract management and governance. It's important for any company to honestly evaluate whether it has the managerial bandwidth to handle more layers in the value chain. Lastly, outsourcing offers strategic flexibility, making it easier and faster to enter new markets, exit declining ones, and avoid large irreversible commitments. This flexibility can be crucial depending on your business strategy and market conditions. Vertical integration provides a unique kind of strategic value by giving companies control over their future paths, protecting them from supplier or platform dominance, and enabling them to reshape industry economics. One key advantage is the ability to tightly control quality and customer experience, which is crucial for brands where consistency builds trust, such as luxury goods or premium technology firms. It also improves coordination and speed since owning adjacent stages in the value chain reduces costs and delays, allowing firms to optimize the entire system and accelerate innovation. Vertical integration can create stronger competitive advantages that are hard for others to copy, by combining unique processes, scale, and experience. Additionally, it lets companies keep more profit internally instead of sharing it with external partners, as long as they operate efficiently. This approach also increases resilience by reducing reliance on potentially fragile or concentrated suppliers, which has become especially important given recent global disruptions. However, vertical integration demands significant upfront investment and ongoing costs, which can increase financial risks if market demand shifts or technology changes. It can also limit a company's flexibility, making it harder to respond quickly to rapid changes in consumer preferences or market conditions. As new technologies emerge and markets shift geographically, assets that once gave a company an advantage can quickly become liabilities. Managing a vertically integrated business is complex because it requires running factories, logistics, retail, and digital platforms all at once, each demanding different skills. A failure in any one area can impact the whole operation. There's also the risk of strategic lock-in, where leaders might stick with existing investments instead of exploring better external options. On the other hand, outsourcing has clear advantages. It lets companies focus on their core strengths like brand, design, customer relationships, or innovation. It also provides cost efficiency since specialist suppliers often operate at a scale that reduces unit costs and speeds up improvements. Outsourcing helps companies get products to market faster because external partners allow for quicker scaling and geographic expansion without the need for long setup times. Additionally, it turns fixed costs into variable costs, freeing capital for other priorities such as marketing, research, or acquisitions. However, outsourcing has downsides. It can mean losing control over quality, ethical standards, or timing, which can hurt a company's reputation if issues aren't handled well. Companies may also become dependent on powerful suppliers who can demand higher prices or influence the company's strategic direction. Lastly, there's a risk of knowledge leakage, where critical information might unintentionally pass to outsiders. Critical know-how can sometimes shift outside the company, which may weaken long-term differentiation. When it comes to supply chain fragility, highly optimized outsourcing networks often perform well but can be vulnerable when under stress. Looking at real-world examples, some companies succeed through vertical integration. Tesla controls battery technology, software, manufacturing, and retail to manage performance and costs. LVMH oversees design, production, and selective retail to maintain brand value, and Amazon manages logistics, fulfillment centers, cloud infrastructure, and delivery to ensure speed and reliability. On the other hand, successful outsourcing is seen in companies like Nike, which focuses on design and marketing while outsourcing manufacturing, Apple, which outsources assembly but keeps control over design and software, and Unilever, which relies on third-party production but emphasizes brand management and distribution. Many leading firms use hybrid models, blending integration and outsourcing selectively. For example, Apple designs chips but outsources fabrication, Zara integrates design and fast fashion production while outsourcing basic manufacturing, and automakers increasingly integrate software but outsource physical parts. This shows that the choice isn't just between integration and outsourcing, but how a company architecturally combines these approaches. Ultimately, vertical integration and outsourcing are tools, not opposing strategies. The key is deciding which parts of the business must be owned because they create advantage, and which can be handed to specialized partners. Successful companies adapt their scope as industries, technologies, and risks evolve. Some integrate to maintain control, others outsource for flexibility. What sets winners apart is clear understanding of where value is created, protected, and captured. The best model aligns economic logic, strategic goals, and execution ability, and evolves as the market does. To wrap up, it's important to remember that while vertical integration can provide control and protect against external pressures, it also brings challenges. Market shifts, new technologies, and changing supply chain dynamics can turn previously valuable assets into burdens. Managing these complexities requires careful consideration of how knowledge and critical capabilities flow within and outside the company. It's a balance between gaining advantage and maintaining flexibility to adapt as conditions evolve.